Welcome back. Well, the next sector that we're putting the spotlight on is the IT space, and that's because it is time for the earnings season, and we are back here with our segment Quarter Se, Quarter Tak, bringing you expectations from each sector day after day. Well, Reema kicks it off, of course, with the IT earnings. Reema, so is there any good news in store first quarter, FY26?
Well, unlikely. So you're not going to see the usual strength that we typically see in Q1 because so far the visibility on demand reviving is very low. So let's look at the early indications from the CNBC TV 18 poll. Well, large caps are showing weakness while mid caps continue to lead the charge. This is the large cap picture, and as you can see, 4 out of the 5 large cap IT companies are likely to report a decline in their revenue. Commentary across the board is likely to reflect that while the macro environment hasn't improved in the last 3 months, the good part is it hasn't deteriorated. Now a little bit more about the guidance. Now, Infosys is likely to raise the current guidance. It stands at 0 to 3%, but they made acquisitions, and therefore that guidance could be upped. If the lower end of the guidance is raised from the current 0 to 1%, it's unlikely to signal anything positive. It's the upper end which needs to move on an organic basis. Now moving on to HCL Tech. HCL Tech too could upgrade the lower end of its guidance. So 2 to 5% may become 3 to 5%. But here is where the good news comes in. Mid-caps are likely to outperform and very strong growth. Look at Coforge. That's been leading the charge in the mid-cap space, and we're expecting about a 6.5–7% kind of a constant currency revenue growth on a quarter-on-quarter basis. Persistent is close to about 3.5–4%, and that's been the revenue run rate, at least quarterly growth rates for Persistent over the last couple of quarters, 3–4%. That's going to continue. Hexafair and Emphasis also upbeat. So mid-caps are likely to report stronger growth, and this is led by some market share gains and favorable portfolio. For instance, a few mid-cap companies have a little less exposure to manufacturing. So that's the key, takeaway. Large caps weak, mid-caps will continue. Now moving on to the stock price performance. As we've been highlighting, mid-cap IT has underperformed. On a year-to-date basis, the Nifty IT has underperformed by nearly 17%. Valuations for large caps are similar to their 5-year averages. But then again, they've got muted revenue. Earnings growth is expected to be fairly muted for the large cap IT companies. So in that context, even if the valuations are not expensive, are they cheap? It's the mid-caps where you are seeing a valuation premium. Now, the mid-cap IT companies are trading at 32–33 times PE on an average, much about a 38–40% premium to large cap IT, which is at about 23–24 times. But that's because the mid-cap IT companies are also likely to report stronger growth. With high valuations are coming strong growth expectations. So this is the EPS estimates for mid-cap IT companies over FY25 to FY27. We spoke about Coforge's strong top-line growth this quarter of 6.5%. Well, they're likely to report a 38% EPS CAGR growth over FY25 to 27%. Hexafair Persistent could see about a 20% kind of growth, much higher than the single-digit EPS growth that large-cap IT companies are going to report. Now, what to watch from TCS, because that's the first one off the block on the 10th. Well, constant currency is likely to decline by 1.5%. The what to watch, the company last quarter told us that the international revenue growth, that's ex of BSNL, in FY26 is going to be better than FY25. Do they hold on to that? Does that commentary get stronger? And one puzzling factor for all analysts is that, margin expectations are not going up. And this is despite reduced contribution coming in from the low margin BSNL deal. So why is that not happening? Why are margins not expanding for TCS? And also, if you remember, last quarter, they decided to defer the wage hike. So the timing of the wage hike will be watched very closely this time. Back to you.
All right, Reema, thank you very much for that. So very, very good explanation as far as the IT sector companies are concerned and what to expect. Coforge, top of the list. I remember Coforge last quarter as well. I think the stock moved 8–10% after earnings. Expectations are equally strong this time around as well. Kawaljeet Saluja is Senior Executive Director and Head of Research at Kotak Institutional Equities. Kawaljeet, good morning. Great to have you with us here. Thanks for your time. So let me just get straight to the point. In terms of stocks that you track the entire gamut of companies there. But with regards to exceptional performers in a weak environment, it's very, very clear. It is, 2–3 of these mid-cap companies. Why is that, Kawaljeet? And, can some of the larger players start to do this as well? What would you be focused on?
Large companies may not replicate the strength shown by mid-tier companies. They have a few things working in their favor. First and foremost is the portfolio mix in itself. As Reema did highlight that many of these mid-tier companies do not have manufacturing and relatively modest exposure to retail. So that will help their growth in the current environment. Second is that they have the benefits of lower size as such. And third is that they can use Gen AI in a lot more proactive way rather than think about the deflationary risk to the portfolio. So as long as you have the right leadership and these mid-tier companies, it's reasonable to expect that they'll outperform some of the larger companies as such. Large companies, of course, again, they have a portfolio challenge in the current environment. And of course, there's some deflationary risk of Gen AI that they have to take into consideration. So this divergence in the performance would continue.
Folks are just pointing out sometimes brokerage notes can have very interesting titles or even stocks. I remember Nomura's note, categorically from last week, they called out Tech Mahindra as a marquee sell. Like marquee, I thought would be something which would be, positive, saying a marquee name or whatever, but it's a marquee sell. But anyway, I think Kawaljeet actually likes Tech Mahindra. Kawaljeet, hi, morning. So that brings me to the overall question on large cap IT, because you still, like stocks like Infosys or TechM. What's the reasoning? What's the rationale? Because the companies, to be fair, have been disappointing investors on growth for a long time. And even in Tech Mahindra, that whole improvement of the margin trajectory, that seems to be just taking really long.
Well, I think they had outlined FY27 as the year in which they are going to get to 15% EBIT margin. I think they're pretty much on track here. So I don't think what the concern should be. I think even in the current quarter, even though their revenues would be muted, they will continue on the margin expansion trajectory. In a turnaround journey, what happens is that there's too much of emphasis on what happens in one quarter rather than the entire journey in itself. And if you look at Tech Mahindra, the kind of improvements they have, the changes they have made on the leadership, the internal process, the deal filter, the structuring of deals, the TCV, I think they're pretty much on the right track on the turnaround journey. And that gives us comfort, on the story as such. Now, of course, if you're going to live by the quarter, then maybe the current quarter may be modest in terms of revenues. But again, you'll have a decent margin performance here. It's just that the overall makeup, we have to basically look at it. We are pretty much comfortable with our...
Okay. That explains Tech Mahindra, but sort of the bigger question on large cap IT, there's clearly, you have conviction on Infosys, maybe not so much on TCS. Both the companies have not really blown the lights out in terms of growth. What makes you still optimistic, and why more Infosys than perhaps TCS?
I think it all boils down to a top-down view on what happens to the overall tech spending. Like, let's say if you take a directional view that tech services spending would remain weak, the way it is right now, then the pessimism on some of these large companies is justified. But I guess, if the assumption is that at some point in time, the spending picks up, which our belief is that it would pick up, given that there's a lot of core modernization, data modernization journey still left in the large, for our clients. And I think that's something which many of these large companies will drive. You can basically expect, a reasonable growth. So at some point in time, there'll also be an uptick in discretionary spending. Our assumption was that, things will start improving in FY 2026. Of course, that got scuppered with the tariff imposition, which means that, normalization of the growth journey got deferred by a year. So now within this context, what you have to look at is that which are the companies that are executing well, and which are the companies that can capitalize on the ensuing opportunities. And I think that's where our confidence in Infosys comes in.
Okay, all right, Kawaljeet, quick conversation today. Out of time, and hope you join us as we review some of these earnings as they start to come in very soon. First out of the block, that's the IT pack, as always. Kawaljeet Saluja at Kotak Institutional Equities.